Do you feel like you can read a chart at an advanced level using SMC? Or that you can identify liquidity, structure, and other concepts, but your strategy is just not consistently profitable? Or that your higher time frame bias works every time, but you're still not getting into the winning trades? A week of great performance followed by a month of confusion and feeling lost in the charts? Well, then today this is the video for you because we're going to talk about the reality of SMC. Alright guys, just a reminder to like and subscribe to the channel if you have not already. We have a huge video in store for you. So we're going to start out with me breaking down the topic a little bit, and then we're going to head into the 2 concepts that you should need as a smart money trader. And then we're going to finish it off at the end with some charting and an actual trade example image where I break down a profitable trade that I took on my live account. So without further ado, let's get right into the video. Alright everybody, welcome back to the Simple Markets channel. As always, this is JB speaking today. And my goal with today's video is to just kind of go over the truth and reality of the smart money industry nowadays. Now, if you answered yes to any of the questions in the intro, I was honestly in a similar position when I started with smart money. Honestly, I spent about 3 years failing with smart money before actually starting to gain some traction and joining a ton of mentorships that basically was just the idea of smart money concepts reworded or renamed. Nowadays, people think that if you learn supply, structure, demand, liquidity, you're going to be an efficient trader. But the reality is, if you don't know how to take these concepts and put them together in a real concrete and mechanical trading strategy, none of it matters at all. And so at the end of the day, based on my 3 years of learning and failure as a smart money trader, I realized it all honestly boils down to one concept that YouTube was failing, and that is complexity. Now, the honest truth behind SMC, some of these larger mentors in the industry, I'm not going to name any specifically, but they do lead traders, and especially smart money traders, down this essentially a wormhole of complex and more intricate trading analysis on a chart. And even nowadays, it seems that the lower time frame, the 1 minute time frames, 5 minute time frames are being pushed more than ever, but it's leading traders into this consistent cycle of finding a strategy, trying to stick with it, having some failing or lower results than they expect in the live markets, and then switching to something new or going to find new concepts. And this is honestly a cycle that, I hate to say it, but will never end unless you yourself as a trader snaps out of it. Honestly, I bet you 90% of the people viewing this video right now, if you're a smart money trader, you can read a chart at a proficient level. You're able to spot your structure, your supply and demand, your liquidity, your fair value gaps, whatever concepts you personally may use as a trader. But the issue is you may not understand how simple trading really needs to be approached. And if you can get yourself to move away from the new strategies, the new concept videos that are being dropped weekly by some of the larger mentors in the industry, you're going to be set up not only for a more mechanical and consistent trading plan, but it's going to be simple enough that you can execute on it longer term. I do think results and actions speak louder than words here. So I'd like to introduce you to 2 specific people, one of them being Fele. Now, he joined our server a couple days ago, and I don't want you to take this as some sort of pitch for the community. I want you to just look at this from a results-based standpoint and understand that this is how trading should essentially work. He was able to take on our strategy that we offer and very simply within just a few days of being in the server. He joined our server on April 2nd, and these results that we're seeing here were sent on April 4th and April 6th, and he even continues to post in the server daily with new results. He's doing a great job in backtesting and keeping up with practicing the strategy. But this idea that a strategy should be able to be picked up on and very instantly from a trader with an understanding of your basic smart money concepts like we talked about, but he's doing a fantastic job right away. You can see consistent results in his equity curve using FX replay for backtesting. And another student that joined us recently, his name is Lucas. You can see here we have his MT4 data, and he's brand new as well, just under a week in the server. And you can see here he does a great job at keeping the losses and wins very consistent. It just shows a very consistent risk management, but on top of that, more importantly, he's keeping those losses small while gaining even larger winners, and you can see the consistency of it here among all the trades he's taken on MT4. I like to show MT4 and FX replay as well because they cannot be faked data. If you're a smart money trader out there and you're in another course or mentorship and it's been taking you 3 months, 5 months, 8 months to see profitability using whatever strategies and concepts they're teaching, it has to do with the complexity that they're teaching it. If a strategy genuinely worked in the financial markets, it should be something that you can pick up on and learn with time and you'll see these results very quickly formulate. Like I said, within a week, both of these traders are now seeing consistent results after struggling in previous courses and mentorships. Alright, now with that out of the way, I want to talk a little bit about the fundamentals of smart money itself. What we're going to go over is two specific concepts. One is going to be liquidity, and the other is going to be volume. Now, liquidity from a fundamental standpoint represents for every $1 buy order, there must be $1 sold at the same price level. Now, if you want to apply this to a candle perspective, if you look at a chart here, for example, if I wanted to sell this pair, let's just call it Euro US dollar, if I wanted to sell $100 worth of Euro US dollar at the level 1.0, there needs to be someone on the other side of the market that is buying $100 worth at the same exact price level of 1.0. That's where the term foreign exchange comes from, that exchange of capital and liquidity within the markets. And now many of us smart money traders understand that the institutions are the one in the control of these markets based on the simple standpoint of having more capital than ourselves. And on an institutional level, instead of $100, they may be working with $100 million, even billion-dollar orders in some cases. So what this means for them is they are not able to get filled on liquidity at whatever level they want. So instead of a singular exchange of $100 million in a sell order on Euro US dollar with a single person, instead these institutions have to operate at a level where millions of traders like ourselves, wherever we have our sell orders in the market, that's the area where they have enough liquidity to then buy the market. So you'll often see price kind of run towards these levels like a magnet, and that effect simply acts as a magnet towards the highest level of liquidity in the market at a certain level, where the majority of orders from your retail traders or large retail banks using those traditional retail trading concepts. And these levels can typically be found at highs and lows of a range or consolidation. And if we look to the image on the left here, we can see we have the high of a range created here, and price works its way towards that, like the magnet effect I talked about. And then they eventually pick up on the amount of liquidity that's at this high. And now institutions can heavily sell off where they intend to go. And if we take a look on the right of the screen here, we can see how an order book may look to an institution. Now, we have the bid and the buyers on the left side, or the ask and the sellers on the right side. And these in the middle just represent the price level that you're looking at on the chart. So there may be 1,000 sellers in this case and 1,365 buyers roughly. And the idea is that this is constantly an exchange of who is buying and selling at what level. And these are how candlesticks are printed. So we can see 1,000 sellers at the current price level absorbed all the buy orders. And that means that we will inevitably see a bearish candle based on the effect of how many sellers are in the market. And if you kind of work down in that perspective, you can imagine an institution cannot fill their orders at this level because 1,000, let's just call this dollars, may simply not be enough to fill their order. So what they may need to do is attract price to a level where there's a majority of orders resting in the market. I don't have a great example in this specific image, but let's just say up at this price level of 1.0785, there was $20,000 worth of orders. If someone wanted to sell or buy $20,000 worth in the market at this moment, they would have to drive price towards that level to then get filled and allow price to be driven in their intended direction. This is very similar to what the institutions do with liquidity, obviously on a much higher level in a much larger scale, but it is essentially the institutions and their need for liquidity versus us as traders and how we interpret the markets, as well as many smaller hedge funds and retail banks out there that are trading those traditional retail concepts or using traditional stop losses at highs or lows of a range, or using traditional stop losses at highs and lows of a range that they can now take advantage of and convert that into liquidity to fuel their intended move. Now that is one of two fundamental concepts in the market and smart money, and now let's move on to volume, which is the second one. Now volume is the second fundamental concept in the market. It's one that I do think is fairly simple, but it goes over a lot of people's heads because they don't quite understand or make the connection to the institutional involvement. But a larger candle or larger move in the market just essentially means the more money was invested or sold in that market to create the move. Now we have the same image here from the previous slide with liquidity, but in this case I do have these purple boxes here, and these are just used to represent what we call imbalance in the market. And an imbalance is created when a very heavy bearish candle or bullish candle is created, and there's a gap between the previous and following candle. So this pattern of 3 candles together where there's a gap between the wicks is what is known as a market imbalance, and this is one key and pretty simple way to spot volume in the market and spot institutional involvement. In order to create these high volume imbalances, there's a substantial amount of money that needs to be put into that market or sold out of that market to create such large moves. And this can only be done, especially in the foreign exchange, by some of these large scale institutions that have enough money to do so. Each individual candle, especially the ones we're looking at here, depending on your time frame, could be worth hundreds of millions of dollars, if not billions of dollars in the foreign exchange market. And combining these two concepts of liquidity as well as volume together is what can go and create a consistent equity curve or an edge over the market, as we see on the right here. And all an edge means is that you have a probabilistic advantage over the market, and your trading plan will deliver a mathematical edge where your winners are worth more than your losers, and you are maintaining consistent profit over time despite the occasional losses that may occur. And we can see that on this equity curve here, where we have 25 trades, and I believe I set 3 risk to reward as a standard here. And you could see there's plenty of losses and dips in this equity curve, but overall you are seeing a consistent uptrend. And I mentioned this just to get the idea of simplicity out of the way, where these two simple concepts are more than enough for a trader to capitalize and create an edge over the market. Everything else is supplemental. It's a tool that can help you. This was prevalent in the data I showed before from the 2 students in our community using that simple strategy that we provide. And I'm going to give you one trade example at the end of this video here to wrap it up on the charts, and I'm going to show you a position that I took using a very simple approach to the market. All right, now the chart we are looking at here, this is pound JPY, pound yen, also known as the beast. Based on those 2 concepts that we talked about, I'm going to kind of break down how I saw this trade, how I took it on my live account. I am in replay tool at the moment, but this trade does stem from those 2 basic concepts and maybe a little bit of supplemental help that I use from basic tools or ways to help identify these concepts a little better, such as structure. But the first thing very clearly I noticed was how high volume this move was that we are looking at here. There are plenty fair value gaps in this range as well, from here to here, for example, or here to here. And this high volume is one indication out of the 2 that we mentioned. And the second one is based on liquidity, which, as I mentioned in the previous slide, can be in the form of consolidation. Now there's consolidation. We have an impulsive bearish move sweeping that liquidity where a majority of orders may lie, and then a very impulsive and strong bullish up move showing high volume. Now, some people ask about how to spot liquidity and why I would consider this liquidity. So from a fundamental standpoint, once again, we are looking at, if you can see down the bottom there, it says Thursday, the 8th of February at 9 a.m. is the beginning of this consolidation. And then the end of it, you can see here, is about 1 a.m. on the 12th. Any order that is placed into the market within this 3-day stretch here has to have an entry at this low or this high within this general range, because obviously you can't have an entry up here when the market never reached it, or an entry down here when the market never reached it. So all the orders in the market rest within this level, and that allows the institutions to have enough liquidity, as we talked about, to grab all the sell orders in this range by pushing through it. And that then allows them to convert it into buy positions and buy very heavily into this market after, followed and showed by that high volume that we talked about. Now, for me personally, I see the liquidity grab here, which followed by some imbalance in the range here, shown from here and here. And I like to see a break of structure that occurs when this happens. And all this does for me is it creates my trading range from this low to this high. And now, however you want to enter this is based on your preference. Some of you may like demand zones, some of you may like supply zones. Me personally, to keep it simple and consistent, I use the 75% of the range. And now I've created a solid setup just based on a few basic concepts and something very simple and replicable that I can maintain long term. And this gives me a consistent edge over the market. And what we're going to do here is just play out price now and see how the position played out. So we can see we got tapped in here, and it did take a little bit of time here, but eventually reached take profit for a 3 risk to return on the trade with a very simple and consistent edge that can be replicated long term. I myself have been using this strategy for a very long time. We have 2 other mentors that have been doing the same, and now passing this down to our many students that are getting funded and trading on their live capital accounts using this. As always, I want to finish this video by saying thank you. I appreciate your time for watching. My name is JB once again. I have my Discord linked below there. It is jblasedell729. It is also in the description as a link. You can click on that and directly be brought to my DMs. Feel free to direct message me with any questions you have about this content or trading in general. If you want to send me your trading plan and have me look over it, I'm happy to do so as well. And then below that, we have our website linked below, simplemarketsacademy.com. Feel free to check it out if you're interested in joining the community. And once again, that's going to be all for this video. Thank you for your time, and I will see you guys next week.